Let's bring in Seema Shah, global investment strategist with Principal Global Investors. Seema, good morning, and thank you for joining us. As we see these trade headlines take hold, is there an indication from your side of things that maybe a lot of this optimism has already been priced into the market?
Yes, definitely. I think most analysts out there do expect to have some kind of progress. I think, if we were to see some real clear improvement and progress with regards to the technology transfer, some of those areas of the negotiations, then I think the market would really do well, because that hasn't been quite priced in. What we do expect to see is some advancement with regards to the tariff side, so maybe China agreeing to increase the amount of imports that they're buying from the US, especially on the agricultural side. But the technology transfer, I have to say, I think is very difficult for China to really put that into effect, given it's so existential to China's plans for the next decade or two.
So Seema, as we look at the way that the markets are reacting to this, yes, there hasn't been a fully priced in market for a China-US trade deal, but there is a little bit of optimism that perhaps the global economy will do better. Do you, in your mind, feel as though a significant development from these trade talks before March 1st could be good for the global markets and global economic setup?
I mean, absolutely. I think I think it really comes from the China perspective that if there are advancement and the US doesn't do this third round of tariffs, or even dials back some of the first and second round of tariffs, that's inevitably very positive for the Chinese economy, and therefore, given the size of the Chinese economy, it's positive for global economy, global markets too. I think, though, however, a lot of this is somewhat priced in, and most of the market move that we're seeing this morning, their kind of positivity in equity markets, is really down to some of the stuff from the Fed yesterday.
All right, speaking of the Fed, let's bring that into the conversation. We do know that the Federal Reserve and other central banks around the world represent one of the bigger market catalysts out there. The Fed seems to be front and center for that. Was there anything that you learned over the course of yesterday, the last couple of days, that makes you feel as though the Fed is still a wild card in this, or is the Fed pretty much on hold for the remainder of the year?
Well, look, I think the thing that most people learned from yesterday was that there's still potential of another rate hike this year. Many people across the market had been expecting after the Fed meeting at the end of January that actually there were no more hikes, and in fact, potentially the next move would be a drop. I think what we learned yesterday is that's unlikely. However, there's still some positive stuff for the people out there, for the doves out there who really think that the balance sheet is going to be ending, the balance sheet reduction is going to be ending sooner than expected. I have to say, though, one of the issues over the last few months has been this difficult in understanding Fed's communication. Which way do they go? What is the Fed reaction function? I think yesterday we learnt a little bit more, so they're a bit clearer to understand, and that can only be taken as a positive for markets right now.
We have gone from a market of relative extreme to relative extreme. I think of what happened at the end of last year, the steep sell-off into Christmas Eve, and then, of course, the sharp bounce back that we have seen. Is there a way from a strategy standpoint that you want to navigate these types of markets? Do we continue to see this? Is this a theme that will continue in 2019? It sure doesn't seem that way, Seema. The VIX is just at these low levels. It doesn't seem like any kind of pessimism is in the market anymore.
I think that's true. I also feel like that's a risk, that it's almost gone from being overly bearish to overly optimistic in January. And that's certainly a risk for markets, because if you do see data continuing to turn down, that would be taken as a negative. I think the fundamental thing, for the market is that now that we know that the Fed is going to be completely data dependent, we can expect to see major market swings with every relevant piece of data that comes out from the US. So every kind of labor market report, anything to do with inflation, the market is going to react to. So I do expect there to be wild swings across the market as the year progresses.
All right, Seema Shah, live in London. Thank you very much for those thoughts this morning. We appreciate them.